Hello friends, welcome to my channel Learn with Dr. Khizer. This is the part 9 video of income from capital gains. So in the previous videos we were discussing about exemptions under section 54, 54D, 54B, 54EC, and today we are going to discuss about section 54EE. So the conditions here when this exemptions can be applied is any taxpayer can apply for this. Any taxpayer assets sold can be any long-term capital asset. So any taxpayer can apply this. And second point is any asset can be sold that should be long-term in nature. And where this amount should be invested, second point tells that investment should be made in long-term specified assets notified by central government to finance startups within 6 months after the date of transfer. So means that any taxpayer can claim this. What is the type of asset that need to be sold? It should be any long-term capital asset. And where this amount should be invested, it should be invested in some long-term specified assets which is notified by central government to finance the startups. So this should be invested within 6 months after the date of selling that particular asset. What is the maximum amount of exemption? Again same, gross capital gain will be compared with the investment made in a particular asset or specified asset. Along with that you are going to add up 50, sorry it is not add up, it is or 50 lakh rupees, whichever is lowest. So these three things you are going to compare: gross capital gain, the amount you have invested in the particular asset, and the amount of 50,000, whichever is lowest, that will be considered here for exemption. So here I will change and make this okay, so that you people will not get confused. It is or. Fine. So this is about section 54EE. Okay. So any person can, taxpayer means the assessee, any assessee can claim. When he can claim? When he is selling some long-term capital asset. After selling the long-term capital asset, if that assessee is investing that amount in a specified asset, okay, which is notified by central government to finance the startups, okay, this should be invested within 6 months after the date of transfer. The maximum amount of exemption can be either the capital gain or the investment amount or 50 lakh rupees, whichever is the lowest, that will be exempted from tax. Okay, hope this is clear to you. Okay, continuing with the next exemption, that is 54F. This is the most important exemption as per the provisions as well as per the examination part of view also. They will ask this type of exemption. This is very important to understand. So condition number 1, when this 54F can be claimed, only individuals can claim, or it should be an HUF, Hindu Undivided Family. So anyways, all our problems will be related to individuals. So that is this can be that is first condition can be satisfied as per examination. Then second point is capital asset. What type of capital asset? Any long-term capital asset other than residential house property. Leaving the house property, residential house property, any type of other asset can be sold here. And after selling this, what we need to do? We need to purchase a new residential house. Okay. If you remember our 54 first provision, here we are selling, same provisions are applicable here also. Okay. But here we are selling the residential house and purchasing residential house. That is 54. But here in case of 54F, we are selling apart from residential house but purchasing the residential house. same rules are applicable, that is 1 year prior to the transfer, or 2 years after the transfer, or if you are constructing house 3 years after the date of transfer. And along with that, if you have deposited any amount in the bank under capital gain account scheme, this also will be considered. Okay, and fourth point says that assessee should not own more than one residential house other than the new on the date of transfer. So while transferring, he should not have any other residential house. Okay, so these are the 4 conditions you should remember. Importantly, second and third condition you should remember so that you will not get confused with section 54. Section 54 tells that residential house should be sold, residential house should be purchased. Section 54F tells that you can sell any other asset apart from residential house and you should purchase new residential house. Okay, hope this is clear to you. Then what is the maximum amount of exemption? If the cost of, first point is, if the cost of new residential house is more than the net sale consideration, entire gross capital gain is exempted from tax. So this you need to understand very clearly. Cost of new residential house, that is what we are purchasing here, third point. Okay, the cost of new residential house will be compared with net sale consideration. Okay, so if the cost of new residential house is more than the net sale consideration, if net sale consideration is less, cost of new house is more, entire capital gain is exempted. Okay, and second point tells that opposite of this, if the cost of new house is less than the net sale consideration, the amount of exemption is allowed proportionately following this formula. So you should see this formula here. So it is told as gross capital gain multiplied by cost of new house divided by net sale consideration. 2 things you should remember while calculating the amount of exemption under section 54F. First thing is, if the cost of new house which you are purchasing is more than the net sale consideration, how we will get net sale consideration? Just let me take you to the formula format. Okay, see here is the net sale consideration, right? So if the cost of new house, now we are learning 54F. 54F will not be applicable for short term, it is applicable only for long term capital asset, right? Okay, so here how to claim this 54F? There should be a residential house property sold, there should be a long-term capital asset sold apart from residential house property, and you should purchase new residential house property following the conditions. So if this is satisfied, how much is the amount to be claimed? So here, how much is the amount to be claimed? Whatever the new house is purchased, that value will be compared with net sale consideration. If net sale consideration is less and the cost of new house is more, entire amount of gross capital gain will be exempted from tax. This will be completely not tax, that is exempted. Means to say that, suppose for example here net sale consideration is 1 lakh and the cost of new house is 1,50,000. Okay, and you have got 80,000 as net sale consideration. In that case, full 80,000 rupees will be exempted from tax and taxable amount will be 0. Okay, if you are not following, then once we solve the problem, clearly you will understand this. Then the second point tells that if net sale consideration is more, here we saw 1 lakh rupees, here we saw purchase is 1,50,000. Okay, if purchase is less and the net sale consideration is more, in that case formula need to be applied. What is that formula? Gross capital gain multiplied by cost of new house divided by net sale consideration. Whatever the amount you will get, that will be exempted from tax. Okay, hope this is clear to you. Okay, don't worry, when we solve the problem you can clearly understand. So in this video we covered 2 sections, 54EE and 54F. Okay, see you in the next video.